To remain updated with the latest business news, click on the bell icon.
Hi, folks. You're tuned into Business Today. I'm Sakshi Batra. Well, the recent sell-off across the global markets and the uncertainty around the geopolitical tensions due to this Ukraine-Russia war has led all investors across the globe worried. But do you know that Indian markets have actually felt more heat and have fallen more than when you compare it with the other global emerging markets in this recent sell-off as well? Now, let us try and understand why this has happened, why there is a divergent trend being seen across the emerging markets. Now, when you compare a 1 month performance of India along with the other emerging market peers, like, say, Brazil, Taiwan, Thailand, China, and South Korea, you will find that the Indian markets have actually felt a deeper pinch of the recent global sell off than most other emerging markets. Now, as per data that has also been shared by my colleague Rahul Oberoi from Business Today magazine, and he's looked at this data from Yahoo Finance and both Ace Equity, we find that in the past 1 month, Sensex has declined by almost 2%, while China and Brazil, Taiwan, Thailand, and South Korea have actually gained in the same period. In contrast, when you compare the performance of the Indian market in the past 1 year, the picture is really quite different. When the Indian market, specifically when you talk about the Sensex, that rose about over 14 odd percent on a 1 year basis, outperforming the MSCI Emerging Market Index by a huge margin. The MSCI Emerging Market Index has, in the same period, slipped by over 12.5% on a 1 year basis, as it was dragged largely by the sell off in China. In the 1 year period, India has not only outperformed the MSCI Emerging Market Index, but has also outperformed the MSCI World Market Index by a huge margin, which has risen about 7%. Now, the key reasons for the recent sharp fall in Indian markets amidst the recent sell-off is perhaps the rich valuations that the Indian markets have been trading at. Remember that as we were entering this new year, 2022, the larger scenario and the larger talk was all about how Indian markets had run way ahead of valuations. The valuations were overheated. And at that point in time, some kind of a cool off could come and a dip could definitely come. So scenarios were already changing for the Indian markets and the one-way rally that we had been seeing for almost 2 years, right after the March 2020 crash, without any meaningful dip or a correction, which is required for a sustainable, healthy, consolidative up move in the bull market that we always see historically. Now, some scenarios kept changing even before the Ukraine-Russia crisis. One, there was a rise in crude oil prices. Two, there was a rise in inflation. The scenarios around interest rates were also building to change, with the US Fed talking about higher interest rate regime coming in much sooner. And bam comes the Ukraine-Russia crisis. Now, this nobody had penciled in. None of the economists, analysts, or even markets had penciled in. In the last 7 days, when we have been seeing this continuous war between Ukraine and Russia, scenarios have changed a lot. Talk about the crude oil prices that have risen very, very sharply, are now trading above $110 a barrel level as well. Also, there are talks about supply constraints as Russia deals with other countries as well. In a lot of fields, talk about crude oil, talk about gold, about wheat, sunflower oil, many other commodities as well. So the trade impact also is much larger. Now, apart from the rich valuations, what also was a trend being seen before the geopolitical crisis was the outflow of foreign money in Indian markets. From October onwards, we have seen that the foreign institutional investors have been selling, cutting exposure in the current risk-off environment. In fact, if it was not for the support of the domestic institutional investors, we would have actually seen a much sharper cut in the Indian markets than the 2% cut that you have seen in the last 1 month. Since October, FIIs and FPIs have been on a selling spree, have net sold over 1.05 lakh crore rupees worth of shares in the Indian markets. Compare that with the domestic market investors and the domestic institutional investors who have pumped in nearly 1.3 lakh crore rupees into the stock markets, thus offsetting most of the impact of the foreign institutional investors sell-off. Now, going forward, to understand the market outlook going forward from here, one will have to wait and watch to find out how long does this Ukraine-Russia crisis really prolong. What could be the impact on supplies, on the financial implications of the trade as well as when you talk about one factor that India will be watching out for, and that is on the interest rate front. The FIIs had been also pulling out money because of the changing interest rate regime. Globally, interest rates were going to be, on an upward trend as per most of the commentaries coming in from global central banks. Now, if the current geopolitical tensions, perhaps make a rethink of sorts by the US central bank and the other global central banks on the raising of interest rate regime, starting this March itself, then India could actually look at a chance of FIIs, making a stall on the continuous selling spree that they have been doing in the Indian markets. And if that happens, if the money starts to come in further, then perhaps the Indian markets will also have something to look forward to. However, most of the experts at this point in time do believe that volatility is still here to stay for some time before it concludes into a concrete direction. This is what Neeraj Chandawar, who is the head of quantitative equity research at Axis Securities, has said. He also said that their long-term view that he holds on the market is favorable structure, and that is emerging due to the increase in the capex spending, which will enable the banks to improve the credit growth going forward as well. He also expects that the overall boost from the recent budget expenditure will definitely help deliver the broad-based growth in FY23 as well. For the year 2022, he still maintains the Nifty 50 target of 20,200 despite the volatility that you're seeing right now. So for the near term and for the medium term, while there may be some volatility, the long-term structure of the markets and the fundamental strong story still remains is what most of the experts are talking about right now. But for now, Indian markets definitely feeling deeper pinch and more heat than the other emerging markets of the recent sell-off caused by the Ukraine-Russia crisis.
If you like the video, do like, comment, share and subscribe.